For most people, a mortgage is the biggest financial commitment they will ever make. Whether you're buying your first home, moving to a new city, or upgrading to a larger house, taking out a mortgage is a major decision. While it can be a great investment in your future, it can also be a significant burden on your finances. That's why it's important to save as much money as you can when buying a home. In this video, I'll tell you 5 ways to save big on your mortgage so you can have extra money to invest in other areas of your life. 1. Negotiate a good interest rate with your lender. One of the most significant ways to save money on your mortgage is to negotiate a good interest rate with your lender. Even a small difference in interest rates can add up to big savings over the life of your loan. For example, if you take out a 30-year mortgage for $250,000 at a 4% interest rate, your monthly payment will be $1,194. If you can negotiate a 0.5% lower interest rate, your monthly payment will drop to $1,123, saving you $71 per month or $25,533 over the life of your loan. To negotiate a good interest rate, start by improving your credit score. Lenders use your credit score to determine your credit worthiness and your interest rate. Generally, the higher your credit score, the lower your interest rate. You can improve your credit score by paying your bills on time, keeping your credit card balances low, and not applying for new credit. Once you have a good credit score, shop around for the best interest rates from multiple lenders. You can use online comparison tools or work with a mortgage broker to find the best rate for your financial situation. 2. Pay bi-weekly or make extra payments. Another way to save money on your mortgage is to pay bi-weekly or make extra payments. By paying half of your monthly payments every 2 weeks, you pay the equivalent of 13 monthly payments instead of 12. This, of course, will help you pay off your loan faster. For instance, if you have a mortgage of $250,000 with a 4% interest rate and a 25-year term, if you make bi-weekly payments of $660 instead of monthly payments of $1,320, you will save over $20,000 in interest and even pay off your mortgage 3 years and 2 months earlier. As you can see, making bi-weekly payments can help you save tens of thousands of dollars in interest and pay off your mortgage faster. You can use a bi-weekly payments calculator to see how much you can save based on your specific mortgage details. Note that even if your lender doesn't offer bi-weekly payments, you can make the extra payments yourself. 3. Make a large down payment. A large down payment simply reduces the loan amount and the amount of interest you have to pay over the life of your mortgage. For instance, you pay more in interest when you make a 5% down payment on a home than if you make a 20% down payment for the same property. It's just maths. A large down payment also reduces your monthly mortgage payments, which allows you to keep money for other things. Additionally, a large down payment may help you qualify for a better interest rate, further saving you money. Of course, that depends on whether or not you can afford the large down payment and the opportunity cost of investing it elsewhere. 4. Compare locations. Choosing the right location for your home can also save you money on your mortgage. If you are flexible on location, consider comparing different areas and neighborhoods to find the best price. For example, a home in the suburbs may be more affordable than a home in the city center. Depending on the state, the price of a 3-bedroom home in the US can be from about $149,000 to more than $900,000. When comparing locations, consider not just the purchase price of the home, but also the property taxes, homeowners association fees, and other expenses associated with home ownership. You should also consider the cost of living in your target areas. So, if location is not a problem, you have the opportunity to save a lot of money on your mortgage. In fact, this is where you probably make the most savings. 5. Choose a shorter loan term. Choosing a shorter loan term can save you money on your mortgage. While a 30-year mortgage may be more affordable in the short term, a 15-year mortgage will help you pay off your loan faster and save you tens of thousands of dollars in interest. For example, if you take out a 15-year mortgage for $250,000 at a 4% interest rate, your monthly payment will be $1,849 and you'll pay a total of $82,860 in interest over the life of the loan. But if you take out a 30-year mortgage for the same amount at a 4% interest rate, your monthly payment will be $1,194 and you pay a total of $179,674 in interest over the life of the loan. That's an interest savings of more than $96,000. While a shorter term may mean higher monthly payments, it can also help you save money and pay off your loan faster. Before choosing a loan term, use an online mortgage calculator or work with a lender to determine the best fit for your financial situation and affordability. Buying a house is a big financial commitment with recurring expenses that can last for many years to come. Interestingly, a lot of the savings on your mortgage can be made before you purchase the property. As a result, doing your research before committing financially is crucial. If you want to save big on your mortgage, consider doing the following. 1. Negotiate a good interest rate with your lender. 2. Pay bi-weekly or make extra payments. 3. Make a large down payment. 4. Compare locations. 5. Choose a shorter loan term. Finally, note that this may not be feasible for everyone, so it's important to speak with a financial advisor to help you assess your personal financial situation with respect to current market conditions and determine the best course of action. Hope you found this video helpful. Don't forget to like it and subscribe to the channel for more. Thanks for watching. I will see you in the next video.